The gold market moves over $183 billion every single day. It is massive, highly liquid, and constantly in motion. For retail traders, that constant motion is the draw. All that volume creates large, rapid price shifts, offering a clear path to capture serious upside in a short amount of time. But there is a catch. Gold's daily volatility is vicious. If you try to day trade this market using tight stop losses, normal intraday noise will routinely trigger those stops and liquidate your account before the real move even starts. The traditional alternative is long-term investing. You avoid the daily noise entirely, but your capital gets locked up in the vault, sitting stagnant while you wait months or years for a return. That binary choice, enduring the constant stress of day trading or parking your cash out of reach, forces you into a flawed compromise. Neither option works if you want active returns without the constant anxiety. The strategic alternative is swing trading. It is designed specifically to capture the multi-day macroeconomic moves in gold. By expanding your timeline, the exhaustive, second-by-second screen time requirement disappears. You gain your day back. The operational premise is straightforward. You hold positions for a few days to a couple of weeks. You ride out the structural trend shifts instead of trying to outsmart minute-by-minute fluctuations. But holding an asset overnight, and especially over the weekend, exposes you to severe market gap risks. Looking at this comparison matrix, surviving those overnight gaps means permanently abandoning your tight day trading risk parameters. You have to build in mathematically wider safety nets. Success here depends on a calculated trade-off. You exchange the constant demand of screen time for the necessity of wider, mathematically sound risk management. Before any capital is at risk, you need a systematic process to validate a gold swing setup. This flowchart shows the top-down approach. We start on the daily chart to establish the primary market trend. Once confirmed, we zoom into the 4-hour chart to execute a precise entry point, filtering out the jagged, volatile noise of 5-minute intervals. The operational trade-off here is volume. Because this filtering mechanism is so strict, you will see a drastic reduction in valid trade setups each week. That reduction protects your capital, but it requires immense patience. You have to sit on your hands and wait for high-probability alignments to form. Exercising that technical patience on the higher timeframes is your crucial first layer of mathematical defense against gold's baseline volatility. Capturing multi-day trends requires looking past internal chart data to the external macroeconomic forces driving institutional volume. Monitor two primary external catalysts: 10-year Treasury yields and the US dollar index, or DXY. Gold and the dollar maintain a strict inverse correlation. When the dollar gets stronger, gold gets weaker. If DXY breaks key resistance, immediately abandon your long gold swing setups. Relying on macro analysis requires you to step outside pure charting. You have to do the fundamental economic homework. Ignoring the momentum of the US dollar is the single most common reason technically perfect gold setups still end in liquidation. Let's look at the math of survival. If you are holding multi-day positions, you need a precise way to quantify volatility. That means utilizing the average true range, or ATR, indicator. This formula matrix shows the professional standard. Set your swing trade stop loss at 1.5 to 2 times the daily ATR. A $40 wide stop loss demands a drastic, proportionate reduction in your position size to prevent account ruin. A sustainable framework for capital allocation limits risk to 1 or 2% of your total account balance on any single swing trade. To enforce that limit with a massive ATR stop loss, you scale down from standard lots and execute using micro lots, 0.01, to keep the risk capped. Amateurs try to apply their heavy day trading lot sizes to wide swing trading stop distances. That mathematical error guarantees a wiped-out account on a single bad setup. In the XAUUSD market, capital preservation through microsizing is vastly more important than targeting aggressive profits. Step back and evaluate the demands of this system. Does a rigorous, math-heavy framework actually align with your personality and your daily schedule? Looking at this trader fit matrix, we can pinpoint the exact profile of the ideal gold swing trader based on these constraints. This method perfectly suits the methodical, time-poor professional. It requires someone who possesses the emotional discipline to step away from the desk and let a multi-day trade breathe. the failure zones are clear. Action junkies seeking constant dopamine hits and undercapitalized beginners who refuse to use microlots will fail with this system. Long-term success in gold trading requires picking the pain you are best equipped to handle, the exhaustion of constant screen time, or the anxiety of wider overnight risk parameters. Executing these precise ATR-driven strategies requires a platform where transactional friction is minimal enough to protect microlot margins. When you are trading microlots with wide stops, bloated broker spreads silently eat away at your carefully calculated risk margins. FXNX provides a high-performance execution environment. They offer 0.0 pip spreads to protect your margins, and proprietary NXAI analysis tools designed specifically to identify those daily and 4-hour chart patterns. You need to see how the ATR position sizing math works in a live market. Open a risk-free FXNX demo account usually